Good morning, everyone. Hey, welcome back to another Ask John segment. You know, this is one of my funnest segments, and I'll tell you why. Because you are asking me the questions. I love it. See, I can tell you my story. of how I deal with different covered call situations. And what happens is I get to become a broken record. Now, for some, that's good because we talk about motivation, we talk about inspiration, the things we have to do to be a great covered call writer, a great investor, right? We're building our financial education. But you know what? I want some new, fresh topics. And by you giving me your questions, it really makes me dig in and really come up with some great ideas. And today we're going to talk about something we talked about last week. You know, last week somebody asked me, hey, look, tell us about how you pick your stocks for weekly, cash printing machine, income. You know the whole deal. Well, I keep getting questions of, hey, look, I want to do the monthlies. How do you pick your stocks in general? And we're going to go through that today. So hang out with me. And hey, I got a song for you, and I think you're going to like it. Okay, hey, let's get going here. First of all, I want to say thank you. Look at those subscribers there. 355. Hey, look, 100% unsolicited, 100% not paid for. This channel does this for you. For me and you. I get out of it the excitement, the motivation, the learning. I hope you do too. And that's why I want you to bang that like button down there. You see it. Hit that like button and let me know you like what I'm doing, okay? Because I get inspired when I see people hit those like buttons. And again, ring my bell. Got to ring my bell if you want that email notification. Hey, let's jump right into it. Man, you guys are going to love this one. I definitely get motivated. And I want you to listen to this song, just these lyrics for these songs, because they apply to situations where we find ourselves feeling helpless. And we thought of everything, but we just got caught. Let's listen to this just for a second. Now, hey, look, I play that because I just find it so appropriate, because we find ourselves in spots where we feel helpless, right? We feel helpless. Maybe we made a swing trade that just went the wrong way. You know, I told you I swing traded Bib and made some good trades on it, and it went south. And, you know, I hate to say it, but I thought of everything in all my charting, and it just kept going down. And you feel helpless. And you ask yourself, what do you do? Well, you know what? We're going to go ahead and talk about how I pick my stocks. Really try to dig into this a little bit. So I get to a point where, you know, we've set ourselves up as best we can to succeed. Okay? It doesn't mean there's no guarantee we're going to succeed, right? There's no guarantees in the stock market. But if we get as close as we can, chances are. So let's go ahead and talk about that. So here we are, another Ask John. Give me more details. Give me more details is what people are asking. Let's go ahead and dig into this. Cindy pumps me up. You know, she lets me know she likes what I'm doing. All of you guys do. I do appreciate that. And Cindy's question, which she asked yesterday, jumps right to the top, largely because I have a bunch of other people asking me this same question. So I will get to your questions, but we're going to talk about this one here. So the thing she struggles with is when is a good time to place a trade. Once she finds an underlying, right? What do you wait for? Do I wait for a pullback, 50-day moving average, overall market pullback? Okay. Or is it better to trade on an up day for a bigger premium than wait for a pullback to buy the option back? Just curious about your strategy. So let's get into, first of all, I've already talked about this last week in the last John, but I'll just blast through them. So we have to set up the trade. And then we're going to pick the great company, right? So first of all, I got to have my rules met. I really want that S&P type company, that Dow type company, because again, they're great stocks. They're going to go up. They're going to go down. All right. And I'm going to be able to sleep with them at night if the market goes down, because that's what the market does. Unless we're having a catastrophic event where, there's no stock market. Yes. They're going to buy them back. They're going to buy back the great companies first. Look, in this world, you just have to understand that the U.S. stock market is where money is made. Because if it wasn't, they would not be jamming money into it since 2008, going from 6,500 on the Dow up to 21,000, right? It's just the quickest, best way for Wall Street to make money. So they're going to run up the great stocks. Hey, look, at the end of the day, Wall Street has to answer to their investors. And when they're investing in great stocks, it's much easier to say to their investors, mutual funds, ETFs, individual brokers, hey, look, markets are generally down. We're investing in great companies like Microsoft and Nike and Disney, right? It's easy. It's easy to invest in those companies. Well, I want to be there too. Why? Because those stocks have volume. And when you have volume, you have buyers. When you have volume, you have open interest. Why do we want open interest? I told you. We want to be able to buy and sell our options, get our price with limit orders. Stock falls down, we want to be able to buy back that option with a limit order. Hey, look, if you have no interest, you have nobody interested in buying it. You're not going to get your price. So I love heavy volume, open interest stocks. They got to have options, obviously, right? Earnings report, man, we really want to shy away from that. You could see from Nike, my last video, Nike would have destroyed me. Hey, it has. I think the last time Nike announced earnings, I held it. I made the mistake as well. Not this time, not this last time, but the time before. I love an uptrending market, sideways trading. Why? Because the stock market is in that nice little non-volatility, right? Non-volatile time, and we can write those sweet out of the money calls, collect our premium, maybe have our shares taken away, maybe not. Right? When you have those violent up and down days, the premiums are juicy for volatile stocks. But man, at the end of the day, if the stock market is trending down, we got trouble because we sell the stock, right? We're owning the stock, right? So we sell that premium, we sell that covered call, and the stock goes down. Yes, I get to keep my premium, and it feels like I got money in my wallet, but the stock is falling down. So you bought the stock at 50, it's now 49. Say you bought 1,000 shares. I don't care if you collected $300 in premium, you're now down $1,000 on the shares. We love the uptrending, sideways trading market. Okay, Bollinger Bands and RSI. We're going to talk about this when I get over to my charts, but we want to look at our Bollinger Bands and RSIs. If the stock market goes down, am I willing to hold the stock? That goes back to number one. And I always consider a dividend distribution when I'm looking to buy my stocks. Hey, that's extra cash in my pocket. I'm going to go ahead. Yeah, I get it. The stock goes ex-dividend. It takes away that, right, in the stock price. But if we have that nice uptrending to sideways market, there is a chance that it will go ex-dividend and there is just a positive vibe in the market. The market runs the stock higher. We get that all back. It becomes transparent to us. Okay? So we're going to start off with those right there. Okay? Now what we're going to do is we're going to go over to PSX. Let's dig a little bit deeper. Remember, a lot of times a chart tells 1,000 stories, right? We just look at the chart and it starts to paint a picture for us. And in the case of PSX, I'm using PSX as an example here because I'm stuck in PSX right now. As you guys know, I bought PSX at 83. I think I wrote one covered call, and it slowly fell into no man's land for me. No man's land for me it's at a point now where I can't write calls. Obviously I can, but I can't write those calls where I feel comfortable, where if it's at 77, I write, let's say, the 81. Premium will be small. The premium will be small. But man, don't you just feel when you own oil stocks, you might wake up and OPEC has woken up with a new idea and the stock jumps. Right? Stock jumps and you missed out on it. Your shares are going to be taken away. You're adding your cost basis because you got to use an exit strategy. Right? So I'm in no man's land. On Friday, I actually bought more shares of PSX down here at 77, lowering my cost basis. So if we get some movement in PSX, I'll be able to write a nice out of the money strike, maybe start making money on it. But let's talk about, would I use PSX right here? I like to look at a couple things. So the Bollinger Bands, there's a whole science behind this, right? If the stock is at the top of the Bollinger Bands, chances are it's going to pull back. If we get consolidation in here with Bollinger Bands, right? It could be poised for a breakout, right? If you get these huge swings up in the Bollinger Bands, chances are you're going to get a pullback. That's how Wall Street plays it. I would suggest that you YouTube Bollinger Bands. There's some great videos and strategies how to play Bollinger Bands for swing trades. But I like to look at Bollinger Bands because if we do get that, uptrending at the top of the Bollinger Band mark, chances are it could pull back. What does that mean? I have two options there. I can buy the stock knowing it's going to pull back. I write the call, right? I write the call, collect the premium, knowing it's going to feeling it's going to pull back. And then as it comes down, right? As it comes down, the premium I got paid, let's just keep the number straight. It's $1 for whatever strike I sold. As this thing starts to peel off, right? This $1 will fall with the stock. And if it peels off, we can buy this thing back for a dime or less, right? We pocket whatever the difference is. We have the stock. We write another covered call. Or we wait for it to maybe give a couple green days. Then we write another call, hoping for the same thing. This is where I'll use a company like Nike, where I know Nike will trade in a nice window. Let's say 60, let's say 50. Right? And I know it's going to dance in here. So it's never going to get away from me. So I'll buy the stock. I'll write a call, buy it back, write it, buy it. You get it? Do it 8 times. Reduce your cost basis. Right? And if the stock were to go above our strike price, we don't worry about it. We will, on the final day, when time decay has come out of the option and that real money in the stock is close to what the actual premium is worth, we then buy it back. We either sell the shares immediately or we write another covered call higher out of the money, paying for the profit cost we just paid. Okay, those are exit strategies. But let's look at PSX a little bit here. PSX right here, you can see, at 83, I actually thought this was a nice pullback right here. I was going to buy it. Notice it did spike higher. Right? I wrote a call there, then, fell. Right? I'm left holding the bag on PSX. Well, for me, like I said, I was really hoping that run right there would give me a chance to write a call. But when I looked at the premiums, they were 30 cents. 30 cents. And it was under my stock purchase price. So if we wake up, it's up here. What am I doing? I'm going to buy it back, right? Pay the profited cost, and then I'm going to try to scramble to keep making money on PSX. So, when I look at these stocks, obviously, I'm drawing lines of support. See that right there? You got a line of support here, and when I bought, you see that line of support? It was after earnings, right? So I thought this was a great line of support. We were going to go higher. No. So getting back to my Pink Floyd song, you think you've done everything. And nothing's guaranteed. Now, let's look at Microsoft. Microsoft, 1 year out. Look at that, 1 year. Just look at that upward trending stock. Just makes you feel good because you can write those out of the money strikes and Microsoft keeps hitting them, right? So you buy it at 60, you write the 62, you collect the 80-cent premium, it goes above it, you have your shares taken away, you got stock appreciation, got the 80-cent premium, you got, let's say, 3 and 4% cash on cash return. Man, you are beating the market, right? Love that. That's why I love Microsoft. Look at that upward trending chart. So to answer the bigger question, when do I like to buy? Let me finish with these questions right here. Cindy asked a question. She says, hey, do you like the 50-day moving average? Well, I do. Of course I do, because the idea here is Wall Street's waiting for the 50-day moving average, or actually they love the 200-day moving average because they figure that's when the real selling has happened, and at the 200-day they can buy it. And when they buy it, they sell the out-of-the-money strikes. They're probably getting some green days. Remember, when we go to sell our calls, right? If it's a green day, that means there's more buyers. And when there's more buyers, your premiums are higher. On a down day, there's less buyers. Your premiums are going to be less. So it's beautiful to have a green day. She also asked, is it good to have a green day somewhere in there? Yes. I always love selling on a green day because remember, the stock and the option that you're looking to sell, they move together. I'll do this with Sands. Sands, wake up, it's up $1.50. Right? I know it's going to sell off. It won't end the day up $1.50, but while it's up in that $1.50 for that day, I know those are the times to get the juiciest premiums for that day. So yeah, I love it on an up day. Love it. You do get bigger premiums. Do you wait for a pullback? Buy the option back. Of course I love that. To me, that's playing the game within the game. Some of you out there don't like that. Hey, you know what? It's how I do it. When I buy Nike, right? I'm thinking, man, I'm going to hope to buy it back. I'm going to hope to buy that option back because that's money in my pocket. I sell an option for $1. I'm able to buy it back for $0.10. I play the game. I wait for Nike to get to a point where I could write another option for 80 cents. Man, if it fell back, buy it back for $0.05. I'm going to keep Nike. I love it. So that question should be, John, are you a trader or are you passionate or are you playing the game within the game, right? Because I love being active and playing the game within the game. And again, I've said this many times in my videos. I've been critical. People have been critical of saying, hey, you pay too much back in premium. You trade too much on this stuff. Well, I love it as long as I got green trade after green trade, okay? So with that said, let's go ahead and I hope I answered your questions, okay? Obviously, with Microsoft, look at that. Chart tells 1,000 stories. Disney's the same way. PSX, not so much. But I love PSX because dividends. I'm going to hold PSX. It's a great company, right? It's down a little bit. I bought some more shares on Friday. I'm going to write more calls. For me, I am not going to fear holding PSX, okay? Now, if we were talking about a one-trick pony pharmaceutical company, of course, but I don't play those, okay? And I would not advise others to. I'm not telling you to go out and overreach the Cobra pit to try to reach for high premiums. It's not how I approach, and that's not what you're going to hear here. Other YouTube channels will say, hey, yeah, get the $4 and $5 and $7 premiums. With that comes risk. If you want that risk, good luck to you. I love balancing the great companies and the risk and the decent premiums. You hear me talking about picking up crumbs. Crumbs is the perfect example of just writing tiny little premiums, collecting them time and time again, right? And when you add those up, 4 and 5 different stocks, we have a nice little nest egg of money, right? We keep doing it. We keep building our success story, right? We keep telling our success story. Hey, look, everybody's criteria is different, but it all basically boils down to having some rules in place and trying to follow them. Hey, look, I can't help you pick those stocks because you're going to have a bias. You're going to love a certain company. You might love Lululemon. You might love Netflix, or you might love Verizon, right? And there's risks that go along with those. I love the stocks you hear me talk about. Okay. And I'm willing to invest in those because at the end of the day, it's risk reward. Those investments might not meet your risk aversion, but hey, the rules, the ideas I presented today, it's going to start to narrow down your list. And for the most part, it's going to put you in, that spot. And hey, look, I hope you learned something with this video. I hope you're getting motivated. I hope you're getting motivated to do the covered call strategy and win time and time again, like I am. Hey, look, 355. I love it. Bang that subscribe button. Hit the like button. I know it's there. Come on, tell me you like what I'm doing. And hey, share. Let other people know. Let other people know that there's a cat on the web that's willing to help that person, right? That one person that needs the information to help them make ends meet. They just need to see the greener grass, right? Maybe they can get money motivated through my videos. Hey, look, at the end of the day, I hope you're doing well. I do hope you find my videos informative and motivative. So until next time, I hope all your covered calls are profitable.
All I see is signs, all I see is dollar signs.